Did you know that there is a tax strategy used by the wealthy to legally avoid taxes? You've probably heard of it as buy, borrow, die. But is it really an unfair tax loophole schemed up by the billionaire class and political elites? Not exactly. Today, we're going to break down how this strategy works and the financial rationale behind it. It consists of three main steps. 1. Buy appreciating assets like stocks or real estate. You do not incur taxes on the gains till you sell them. 2. Borrow against those assets instead of selling them, because loans are not income, but a debt that needs to be repaid. Hence, this money would not be taxed. 3. Die. Your heirs inherit those assets on a stepped-up basis, wiping out capital gains taxes. At face value, this does look like it benefits wealthy individuals to avoid taxes, but is it a loophole designed by the rich and corrupt? A loophole is usually an unintended gap or contradiction in the law, a deviation from the creator's intent. But buy, borrow, die? It's not accidental. The logic? Let's look at each step individually. At the buy step, the capital gains in value of the assets are only taxed when they are sold. These are called realized gains, which means you have received the appreciation in the value of the asset as money. This is taxed as capital gains since you've received the profits from the sale of the asset. If you haven't sold the asset, you can determine the increase in its value either by an appraiser or a market. This is called unrealized gains and are not taxed for a couple of reasons. Till the asset is sold, the gains are only theoretical. Valuations are inherently based on assumptions about the future. This is why we see stock prices falling based on the expectation of a recession, instead of once you are in a recession. Taxing unrealized gains would mean paying tax on money you haven't actually received. This would be especially problematic if you are taxed during a boom and sell when the markets crash later. You would have to pay a higher tax amount even though your actual profit is much lower or at a loss. There are also liquidity problems with such a tax. If you don't have any alternate source of income to pay the tax, you would need to sell some portion of the asset to pay it. The borrow step seems much more intuitive. You shouldn't be taxed on a loan since you will have to eventually pay back the amount and with interest. The only difference in this strategy is to borrow against your asset. You can pledge your property or shares and the bank will provide some percentage of the asset value as a loan. This depends on the asset and could be up to 80% for real estate and maybe 50% for shares. The benefit of borrowing against an asset is the bank now has the asset as collateral to protect against a default on the loan. This would make it a secured loan which would have a lower interest rate than a similar unsecured loan. The die step is generally the most controversial since it allows a step up in basis. What this means is that when someone inherits an asset, like a house or stock, the asset's cost basis is stepped up to its market value at the time of the original owner's death. Let's take, for example, your grandfather buys Apple stock for $10,000 in 1980. This is the cost basis for the stock and will be used to calculate the profit or loss. He passes away in 2024 and you inherit his portfolio, which is now worth $10 million. That's a $9,990,000 unrealized gain. When the step up in basis is applied, the cost basis resets to the current market value, $10 million, not $10,000. If you now sell the stock, you would not pay capital gains since the current price and cost price are both $10 million, indicating zero profit. Thus, you could sell the stock to repay the loan without paying capital gains tax on it. One of the reasons for the step-up basis is to encourage estate planning. The rule encourages people to hold on to appreciated assets until death rather than selling them during their lifetime. This makes it easier to pass wealth to heirs, especially small businesses or family farms, without triggering large capital gains taxes. Without this, the heirs would be forced to sell off part of the asset to pay their tax bill. Depending on your local tax laws, it could also be to avoid double taxation. If someone inherits an asset, like real estate or stocks, the original owner may have already paid taxes during their lifetime, including income, capital gains, and estate taxes. Taxing the built-in gains again when the heir sells the asset would effectively tax the same appreciation twice. In some cases, it also makes administration simpler by avoiding complex record keeping. Imagine trying to figure out what your grandmother paid for a piece of land 50 years ago. The original cost basis might be lost, unclear, or require massive effort to reconstruct. The step-up basis simplifies this by resetting the value to the asset's fair market value at death. So now that we know the reasons behind these tax rules, is it really a loophole? I would argue it's not, since most of the tax avoidance it provides has a financial rationale behind it. Most critics covering this topic also tend to leave out the part where the borrower has to repay the loan, which would require you to sell some portion of the asset and incur capital gains tax. If anything, it simply allows you to defer your capital gains to a later date. Another reason people may feel it unfair is because the example provides a very rosy version of this scenario. In reality, the borrower takes on the risk of the asset falling in value, causing you to either sell at an unfavorable price. In such a scenario, you would be worse off since you would have to sell more of your asset to repay the loan and interest while paying capital gains tax on the sale. At its core, this is an example of financial leverage. But does it disproportionately benefit the wealthy? The short answer is yes. Wealthy individuals generally have more of their net worth in assets like stocks, while middle class or lower would see more of their net worth coming from incomes like salary. Not to mention, the more valuable the asset, the greater the tax avoidance benefit. So, while the strategy can be employed by anyone, the wealthiest individuals tend to make the most of it. Thanks for watching. If you found this helpful, click that like button and subscribe for more videos on financial concepts.